Imagine this. You open your email and there it is. A message from HR with the subject line, "Your new equity award." You've just been granted restricted stock units, or RSUs. Suddenly, your compensation isn't just a salary anymore, it's a stake in the future of the company. For a moment, you feel a surge of excitement. This could be life-changing. This could be the key to a down payment on a house, paying off student loans, or finally achieving financial freedom. It feels like you've just been handed a winning lottery ticket. But almost as quickly as the excitement hits, a wave of uncertainty follows. Because that lottery ticket isn't cashed just yet. Restricted stock units can be one of the most powerful engines for wealth creation available to an employee today. We've all heard the stories of early employees at tech giants becoming millionaires, their lives completely transformed by the value of their stock. However, for every incredible success story, there's a cautionary tale that's rarely told. RSUs can also be one of the fastest ways to see your net worth evaporate if you don't handle them with a clear, informed strategy. Holding on too long, misunderstanding the complex tax implications, or failing to diversify can turn a potential windfall into a devastating financial setback. The difference between these two outcomes isn't luck, it's knowledge, and that's almost certainly why you're here. If your company just dropped a significant RSU grant into your compensation package, your mind is probably racing with a dozen questions, each one more urgent than the last. The big one, of course, is, what do I do when they vest? Do I sell them immediately? But it's never that simple, is it? You're also wondering, how much tax will I owe and when do I owe it? My company mentioned something about withholding shares for taxes. Is that a good deal? Or am I losing money? What exactly is a vesting schedule and how does a cliff work? Then the more strategic questions start to creep in. Should I hold on to the shares, hoping the stock price goes up? How much of my net worth is it safe to have tied up in this one single stock? What's the difference between ordinary income tax and capital gains tax when it comes to RSUs? And what if I'm not in the US? How do international tax laws affect my grant? It's a dizzying array of questions, and finding clear, unbiased answers can feel impossible. Well, today we're going to cut through all that noise. We are going to break down every single aspect of your RSUs in plain, simple English. This isn't just a quick overview. This is a comprehensive masterclass designed to give you complete confidence in your financial decisions. By the end of this video, you will have a personalized, actionable plan for your RSUs now and beyond. We'll start with the absolute basics. What an RSU is and how the life cycle works from grant to vest. We'll then dive deep into the most critical and often misunderstood topic, taxes. We'll show you exactly how RSUs are taxed as income upon vesting and how to plan for it, so there are no nasty surprises. We'll walk you through a step-by-step guide on selling your shares and what to do with the proceeds. But we won't stop there. We'll explore advanced strategies like sell to cover versus selling all shares and paying taxes separately. We'll debunk common myths and bad advice you might hear from colleagues. We'll look at real-world case studies to see how different strategies play out. We'll even touch on special considerations for employees working abroad. We'll use clear graphics, on-screen examples, and expert insights to make sure every concept is crystal clear. Our mission is to transform that feeling of confusion and anxiety into one of empowerment and control. Your RSUs are a valuable asset, and you deserve to know how to make the most of them. You've earned this opportunity, and now it's time to learn how to manage it like a pro. So grab a notebook, and let's get started. To kick things off, tell us in the comments below, what is the single biggest question you have about your RSUs right now? Let's build this knowledge together. RSUs are basically a promise from your company to give you shares in the future, but only if you meet certain conditions, like staying with the company long enough. Vesting schedules, cliff versus gradual. Let's say you're granted 1,000 RSUs today. Instead of getting all of them right away, you might get 250 per year over 4 years. That's your vesting schedule. RSUs equal sign. You get shares once they vest. Stock options equal sign right to buy shares at a set price. RSUs are usually less risky. They always have some value, unlike options that can expire worthless. This is why most tech companies, banks, and startups now use RSUs to attract talent. It's simpler for employees and guarantees something of value. Let's dive into what is arguably the most confusing and costly aspect of restricted stock units: the taxes. Getting this wrong can lead to surprise tax bills, missed financial opportunities, and a lot of unnecessary stress. The single most important principle to understand is this: RSUs are taxed as ordinary income on the very day they vest. Think of it this way: the moment those shares become yours, the IRS views it not as an investment gain, but as a form of compensation, identical to your salary or a cash bonus. It doesn't matter if you haven't sold the shares, and it doesn't matter if the stock price goes down the next day. On vesting day, the value of those shares is considered income you have received. This income is subject to the same federal, state, local, and payroll taxes, like Social Security and Medicare, as your regular paycheck. This is a critical distinction because many people mistakenly believe their RSUs will be taxed at the lower capital gains rates from the start. That's not the case. The initial vesting event is always, without exception, an ordinary income event. Let's make this tangible with a clear example. Imagine your grant specifies that 250 of your RSUs are vesting today. You check the stock market, and your company's stock closes at a fair market value, or FMV, of $100 per share. The math is straightforward. 250 shares multiplied by $100 per share equals $25,000. Boom! In the eyes of the tax authorities, your employer just paid you an extra $25,000. This amount is now considered taxable compensation for the year. You'll see this exact value, or something very close to it, added to the total income reported in Box 1 of your W-2 form at the end of the year, right alongside your salary. This is what we call phantom income. You haven't received any cash, but you have received a valuable asset, and you owe very real taxes on its value. This is the first major hurdle where people get tripped up. They see the shares in their account, but don't realize a taxable event has already occurred, and the clock is ticking on their tax liability. Now, you might be thinking, okay, but doesn't my employer handle the taxes for me? And the answer is yes, but here's the catch. Your employer withholds taxes, but often not enough. By law, employers are required to withhold on supplemental wages, which includes RSUs. The default federal withholding rate for this type of income is a flat 22% for amounts up to $1 million. The problem is that many professionals, especially in high-paying fields like tech and finance, are in a marginal tax bracket that is significantly higher than 22%. Your top tax dollars might be taxed at 24%, 32%, 35%, or even the highest federal bracket of 37%. Let's go back to our $25,000 vesting event. Your employer will likely withhold 22%, which is $5,500. However, if you're in the 32% tax bracket, your actual federal tax liability on that income is $8,000. That creates an immediate tax shortfall of $2,500. And we haven't even mentioned state taxes yet. If you live in a high-tax state like California or New York, your combined marginal rate could easily exceed 40% or even 50%, making that shortfall even larger. This is how people end up with shocking five-figure tax bills they never saw coming when they file their returns in April. This confusion leads to a very common and potentially risky mindset we see discussed online all the time. You'll see videos and forum posts titled RSU Tax Tips, where the prevailing wisdom is to just hold on. Many people think, I'll just hold my RSUs and wait for the stock to go up. I believe in my company and I don't want to sell now. They might do this because they're chasing higher returns or because of an emotional attachment to their company stock. But often, it's rooted in a fundamental misunderstanding of the tax implications. They believe that by not selling, they are deferring the tax liability. As we've just established, that's incorrect. The tax on the ordinary income portion is due in the year of vesting, regardless of whether you hold or sell. Holding the shares doesn't avoid the initial tax. It only exposes you to additional risk if the stock price goes down while you're still on the hook for the tax bill based on its higher value at vesting. This brings us to the myth of double taxation. If you're not careful, it can feel like you're getting taxed at vesting and later at sale. The reality is that there are two separate and distinct taxable events you need to plan for. The first is vesting, which creates ordinary income. The second is the eventual sale of the stock, which creates a capital gain or loss. The key to bridging these two events correctly is understanding your cost basis. Your cost basis is the fair market value of the stock on the day it vested. In our example, your cost basis is $100 per share. When you sell those shares, you only pay capital gains tax on the appreciation your cost basis. So if you sell a year later for $120, your capital gain is just $20 per share, not the full $120. The double taxation nightmare happens when people fail to report their cost basis correctly. Brokerage statements for RSUs can be confusing, and sometimes the basis is reported as zero. If you don't correct this on your tax return, you'll end up paying capital gains tax on the entire sale price, including the portion that was already taxed as ordinary income. This is a costly, unforced error. So, how do you avoid these pitfalls? You need a proactive strategy. Pro tip: the first step is to understand your numbers. Check your marginal tax bracket and compare it to your employer's 22% supplemental withholding rate to estimate your shortfall. From there, you have a few options. 1. You can set aside extra cash from your savings with each vesting event to cover the anticipated tax bill. 2. You can adjust your Form W-4 to have more tax withheld from your regular paychecks throughout the year. Or 3. A very common strategy is to immediately sell a portion of your vested shares, not just what the company sells, but enough to cover your entire estimated tax liability. This sell-to-cover approach ensures you won't need out-of-pocket cash. An even more disciplined approach many financial advisors recommend is to sell all of your RSUs the moment they vest. Treat it as a cash bonus, pay the taxes, and diversify the rest. This eliminates concentration risk and simplifies your financial life. Whichever path you choose, the key is to have a plan your shares vest. If you live in a foreign country or are considered a tax resident outside the US, your RSU tax situation can be much more complex. First, check if your country has a tax treaty with the US. This can affect how your RSUs are taxed and whether you get credit for US taxes paid. In many cases, you may owe taxes both in the US and your country of residence, but you might be able to claim a foreign tax credit to avoid double taxation. Always report your RSU income to your local tax authority, and keep detailed records of vesting dates, share values, and any taxes withheld. Some countries require you to report foreign assets or accounts, so consult a cross-border tax advisor to ensure full compliance. Tax rules can change quickly, so never assume US guidance applies to your situation abroad. Once your RSUs vest, you arrive at a critical crossroads, a decision that can significantly shape your financial future. The big question is no longer you'll get the stock, but you'll do with it now that you have it. This decision isn't just about numbers on a screen. It's deeply intertwined with your personal financial goals, your tolerance for risk, and even your emotional connection to the company you work for. You essentially have 3 primary choices, each with its own set of risks and rewards. You can sell immediately, hold for the short term, or hold for the long term. There's no single correct answer that applies to everyone, but by understanding the mechanics and implications of each path, you can find the strategy that is unequivocally right for you. Let's break down each of these options in detail. First up is the strategy most financial planners recommend as the default logical starting point: sell immediately. This approach is great if your primary goals are to cover your taxes and immediately diversify your investments. The core principle here is to treat your vested RSUs exactly like a cash bonus. Think about it. If your company gave you a $50,000 cash bonus, would your first instinct be to take that entire amount and buy $50,000 worth of your company's stock? For most people, the answer is no. You'd take the cash, set aside what you owe in taxes, and then decide how to best use the rest, perhaps for a down payment, to pay off debt, or to invest in a diversified fund. Selling your RSUs immediately allows you to do just that. It converts a concentrated, volatile stock position into flexible cash that you control. This move instantly de-risks your position. You lock in the value at the time of vesting, which simplifies your tax situation immensely. The value of your vested shares is considered ordinary income, and by selling right away, you know exactly how much cash you need to set aside for the IRS. You avoid the nightmare scenario of holding the stock, watching it fall in value, and still being on the hook for a large tax bill based on its higher value at vest. This strategy is particularly well-suited for individuals who are risk-averse, need the liquidity for upcoming life expenses, or recognize that their financial well-being, their salary, their bonus, their career progression, is already heavily tied to their employer's performance. Holding a large stock position on top of that is like having all your eggs in one basket while you also work at the egg factory. Selling immediately diversifies that risk. The second path is to hold for the short term. This is a high-risk, high-reward strategy. Here, you're making an active bet that your company's stock will increase in value in the near future, typically in less than a year. Perhaps you believe the stock is temporarily undervalued, or you're anticipating a positive catalyst like a blockbuster earnings report or a new product launch. If you're right, you could amplify the value of your compensation. However, the risk is just as significant. The stock could just as easily tank due to a market downturn, poor results, or unforeseen challenges. This strategy effectively turns your compensation into a speculative trade, and it comes with a significant tax disadvantage. If you sell the stock for a profit within 1 year of its vesting date, that profit is considered a short-term capital gain. Short-term gains are taxed at your ordinary income tax rate, the same high rate that applies to your salary. This can take a substantial bite out of any profits you manage to make. Furthermore, there's a psychological cost. Holding a volatile stock short-term can be incredibly stressful, leading to emotional decisions like panic selling during a dip or getting greedy at a peak. This path should only be considered by those with a very high risk tolerance, a strong, well-researched conviction about the stock's near-term prospects, and who can financially withstand the loss if their bet doesn't pay off. The third option is to hold for the long term. This strategy is for those who truly believe in the company's future and are prepared to handle the inevitable volatility along the way. Holding for the long term means keeping the shares for more than 1 year after they vest. The primary motivation here isn't a short-term pop, but a fundamental belief in the company's vision, market position, and leadership to drive substantial growth over many years. You're not just an employee, you're adopting the mindset of a long-term investor. The main mechanical advantage of this approach is tax-related. By holding the shares for over a year, any gains you realize upon selling are classified as long-term capital gains, which are taxed at a much lower rate than short-term gains. This can result in significant tax savings. However, the risk of concentration remains a major concern. Even for the most promising companies, it's rarely wise to have a huge percentage of your net worth tied up in a single stock. A prudent approach to long-term holding involves a plan. It might not mean holding your vested RSUs, but rather a calculated portion that fits within a disciplined asset allocation strategy. For example, a financial advisor might suggest that no single stock should constitute more than 5 to 10% of your overall investment portfolio. This allows you to participate in your company's potential upside while still protecting yourself from the devastating impact of a potential downturn. So how do you put this all together? Imagine your company stock vested at $100 and then doubled to $200 over the last year. It's incredibly tempting to hold on forever, right? This feeling is fueled by a psychological trap called recency bias, where we expect recent performance to continue indefinitely. But what if a market correction or a weak earnings report causes it to drop 40% next quarter down to $120? You're still up from your vest price, but the emotional pain of losing 40% from the peak is immense. This is why financial planners often recommend a hybrid approach that captures the best of these strategies. It starts with selling at least part of your RSUs right away. A disciplined plan might look like this. First, upon vesting, immediately sell enough shares to cover your tax liability. This is called a sell-to-cover transaction, and it removes tax uncertainty from the equation. Second, systematically sell additional shares over a set period, say 25% of the remainder each quarter for a year. This methodical approach, known as a predetermined selling plan, removes emotion from the decision-making process. It helps you diversify gradually, averaging out your sale price over time. The ultimate goal is to transition your wealth from a single, concentrated stock position into a diversified portfolio that aligns with your long-term financial goals, turning your hard-earned compensation into lasting financial security. Think of your wealth like a garden. If all your plants are the same crop, one disease wipes you out. That's what happens if too much of your net worth is in your company's stock. Financial experts suggest using RSUs as a way to build your broader portfolio, selling some and reinvesting into index funds, real estate, or retirement accounts. From RSU tax traps, executives need to avoid ignoring taxes, assuming company withholding is enough, overconcentration, 50% plus of net worth tied to company stock, waiting too long to sell, thinking the price will only go up, quitting before vesting, leaving your job too early and losing unvested shares. RSUs can make you wealthy or broke, depending on whether you avoid these pitfalls. From 5 tips for dealing with RSUs in 2025, set aside cash for taxes early. Automate selling a % of shares on vesting. Reinvest proceeds into safer, diversified assets. Use RSUs to max retirement accounts, 401k IRA. Work with a planner if grants are large. A client had $200,000 in RSUs vest last year. By selling half immediately, covering taxes, and investing the rest into an S&P 500 fund, they reduced risk and still grew wealth steadily. RSUs are a powerful wealth-building tool, but only if you understand taxes, have a selling plan, and don't get overexposed to your employer's stock. If you found this helpful, hit that like button, subscribe for more strategies on building wealth today, and drop a comment with your RSU questions. This is Building Wealth Today TV, helping you turn your paycheck into wealth. See you in the next video.